ETH has been dominating the headlines lately with rising hype and ever higher price targets. As always, this FOMO has everyone overlooking everything that could go wrong. So today, we're looking at the biggest risks to Ethereum, what kind of impact they might have, and what all of this means for ETH. My name is Nick, and if you hold ETH, this is a video you cannot afford to miss. First up, I am not a financial advisor and nothing in this video should be considered financial advice. This is educational content meant to inform you about Ethereum. And if you want more content like this, then hit those like and subscribe buttons, smash that notification bell, and let's get into it. We'll start with the first and arguably biggest risk to Ethereum: competition. Over the years, ETH has become the second largest crypto, largely because of its narrative as a digital oil for the future financial system. Logically, the assumption was that if major institutions were to settle on-chain, it would be on Ethereum. They want robustness and deep liquidity, and Ethereum has both as the most decentralized smart contract chain with the most on-chain capital. But institutions are here now, and the reality is a bit different. Demand is moving into Ethereum virtual machine or EVM ecosystems that may feel like Ethereum, but have the switches institutions like to control. And one such example is Converge, an Ethereum-compatible network co-built by Ethena and RWA giant Securitize. Converge is pitched as, quote, the settlement layer for traditional finance and digital dollars. Basically, it lets institutional players do what they want to do on blockchains like Ethereum's Layer 1, but within their own ecosystems and guardrails. In other words, the EVM's convenience without Ethereum's public chain issues and constraints. At the same time, markets are rewarding speed and efficiency over decentralization. Solana is one of this cycle's success stories, hitting as many monthly active addresses in June as all other Layer 1s and Layer 2s combined. And when it comes to on-chain futures trading, Hyperliquid just printed a record $319 billion in monthly volume. And that proves traders will happily meet liquidity on more centralized rails if the user experience is great. And then comes the competition from fintech. Robinhood launched tokenized stocks on Arbitrum and is building its own Layer 2 using Arbitrum's tech for native issuance. Great for onboarding, less great for Ethereum Layer 1 fee capture. Not only that, but Ethereum's recent updates have slashed roll-up data costs, and this has been a win for users, but it also means that booming Layer 2 usage doesn't translate into strong revenue for Ethereum's base layer. Bad news for ETH value accrual as things stand. More recently, there have been even more twists in Ethereum's original vision. Now, stablecoin issuers themselves are starting their own chains. Circle just introduced Arc, an EVM-compatible Layer 1 purpose-built for stablecoin finance with USDC as the native gas. If stablecoins were crypto's ChatGPT moment, as Bitmine's Tom Lee argues, that moment may not accrue to Ethereum even if a majority of stablecoins are currently on Ethereum. Given the circumstances, this seems likely to change, especially with stablecoin issuers launching their own chains. So, on the one side, Ethereum faces competition from fast and cheap public chains like Solana and purpose-built venues like Hyperliquid. On the other, walled garden EVM-based chains from fintechs and stablecoin issuers that copy Ethereum's experience while capturing the fees. To be clear, none of this points to an imminent liquidation cascade for ETH, but it does cast real doubt on the long-term upside. If everything that was originally designed for Ethereum keeps migrating to Layer 2's faster Layer 1s and issuer-owned EVM rails, Ethereum ends up doing the heavy lifting while capturing less of the value or even being cut out entirely. And this ties into the second risk for Ethereum. It's a word crypto natives have feared for a long time: regulation. Although there is now a very pro-crypto regime in the US, there are still real regulatory risks for Ethereum. And let's focus on regulatory issues at the core of crypto's ethos: privacy and censorship. Crypto mixer Tornado Cash is a great example here. Tornado Cash was sanctioned by the Office of Foreign Assets Control, or OFAC, back in 2022, making it illegal for US users to use it. While these sanctions were eventually overturned, the reality is that government bodies can still step in to choke crypto if they wish. Tornado Cash co-founder Roman Storm was found guilty of unlicensed money transmitting conspiracy, which presents a risk to devs who may be looking at privacy tooling. But it's not just about Tornado Cash either. Ethereum has faced real criticism over censorship before. After the merge in 2022, when Ethereum switched to proof of stake, most validators began using something called MEV boost relays to maximize revenue. We won't dive into that today, but the takeaway is that many of these relays enforced OFAC sanctions. According to Blockworks, at one point in late 2022, more than 52% of blocks were built by relays that had excluded sanctioned addresses. Within a year of the merge, even one of the largest producers of censorship-resistant blocks, Bloxroot, eventually decided to fully block OFAC-sanctioned addresses. While censorship rates later eased, the episode showed how middleware economics and regulatory pressure can push Ethereum toward censorship by default. Bear in mind, while the current US regime is pro-crypto, future elections could change that, and this could eventually leave Ethereum with two tough outcomes. Either it can accept hard edges like more KYC checks and geo-fenced apps, or debate major protocol changes that would likely be met with backlash from crypto users. Neither sound great, right?
Right?
Now, you might be thinking, well, regulations that apply to Ethereum will apply to other layer 1s, and you'd be right. However, as we alluded to earlier, Ethereum's true value is tied to it being the most decentralized and censorship-resistant layer 1. But it must now bow to censorship as countries begin to formalize crypto regulations that could ruin one of Ethereum's biggest selling points. We can already see some of this impact in crypto's strongest product, stablecoins. Europe's regulatory framework, MiCA, put strict rules on the table, and the US now has a legal framework for stablecoins following the Genius Act. Where did all of that lead? Yes, as we mentioned, USDC Issuer Circle decided to spin up its own chain, not just to capture more value, but to ensure it can stay compliant. We're currently in a pro-crypto regulatory environment, but that could shift to a much more hostile one in the future. In either case, Ethereum could remain a neutral settlement layer, but it could lose more of its value proposition with every additional piece of regulatory constraints that's put into law. Again, this is not something that would result in ETH's price collapsing in the short term. This is more impactful to ETH in the long term if such risks begin materializing in more serious manners. For the time being, factors such as big corporate treasury bids have been pushing ETH's price up, but we'll get onto why that also poses a risk a little later on. First, I need to tell you about the Coinbureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges around. Now, to get these crypto goodies, all you need to do is follow the link in the description or scan this QR code. Once you get on the deals page, find a deal that suits you and click one of the Sign Up Now buttons. Now, these deals, they won't be around forever, so take advantage of them ASAP using the link down below or by scanning this QR code. Now, our third risk for Ethereum is a big one: institutional capture. This cycle has been marked by the arrival of institutions getting involved in crypto. However, they're not just buying ETH. They're on track to have a stake in the Ethereum network itself. For context, BlackRock's iShares Ethereum Trust now holds about 3.5 million ETH, about 55% of the spot Ethereum ETF market. Spot Ethereum ETFs as a whole account for around 5% of ETH's circulating supply at the time of shooting this video. And this is a problem when you add staking into the mix. BlackRock has already filed to add staking to the Ethereum ETF. Other TradFi issuers have similar amendments in process. If, more likely when, staking is approved for these ETFs, it won't be long before institutions like BlackRock are running a lot of validators on Ethereum. And this will further put block production in the hands of the exact firms that Ethereum was designed to challenge. Not to mention, these are firms whose entire mandate is to minimize operational and regulatory risk and strictly follow compliance requirements. It's even worse when you look under the hood. At launch, 8 of 9 Ethereum ETFs selected Coinbase custody to hold their ETH, including BlackRock's. If Coinbase is also selected as the stake-in partner for these ETFs, it could result in even more centralization. Now, for reference, Coinbase already runs around 120,000 validators, securing 3.8 million ETH, and that's over 11% of all staked ETH. Once ETF staking turns on, operational convenience and liability management push industry players to keep things very close to home. And that is, more centralization begets further centralization. The net effect here could be that decisions about transaction inclusion norms and upgrade preferences start reflecting the will of institutions, not the global mix of players Ethereum grew up with. And this could someday mean things like KYC to use Ethereum. Make no mistake, we already have crypto-native giants like Lido that display significant market dominance within liquid staking. But the difference is that these crypto-native protocols are unlikely to do something that goes against the will of users and ETH holders. BlackRock and other TradFi institutions, however, may not be so kind. After all, the incentive for BlackRock and Fidelity is not to scatter their ETH across dozens of independent validators because crypto Twitter asked nicely. And that, my friends, is how you wake up with a validator cartel you never voted for. Polite, well documented, but decidedly not neutral. Now, don't get confused here. ETH's recent rally has largely been thanks to the institutions we're discussing. The big boys pumping our bags is great and all, but if that pump cements a validator set dominated by ETF issuers and custodians, we've swapped a narrative pop for a slow erosion of Ethereum's core value proposition. Ethereum looks investable right up until the day it no longer looks permissionless, even if it's just in perception rather than reality. Again, that's a higher today, lower ceiling tomorrow kind of setup, bullish short term, but potentially self-defeating over the long term. Now, our fourth risk relates closely to our third, and that's digital asset treasury companies. Along with spot ETF flows, these companies were the other big factor behind BTC's massive run over the last couple of years. And what do you know? It looks like they're running the same playbook for ETH. If BTC has MicroStrategy, now Strategy, then ETH has Bitmine. Although it is also involved in Bitcoin, Bitmine is currently laser-focused on accumulating ETH and has acquired over 1.5 million coins, making it the largest corporate ETH holder by a wide margin. SharpLink Gaming is the clear number 2 with 740,000 ETH and counting. Coinbase is in third, followed by BitDigital and ETHZilla. The list goes on, but the takeaway here is that more and more companies are piling into the ETH treasury trade. Add up the current list, and CoinGecko now thinks that about 2.3% of ETH's circulating supply is parked in these publicly traded companies. However, Standard Chartered thinks that share could push toward 10% if the current playbook continues. So, that's the bull pitch, supply sink. But the big bear is uglier and much faster. Digital asset treasury companies for both BTC and ETH are growing in number, and a lot of them are small, unprofitable, and funding dependent. The media is already framing it as a, quote, new crypto gold rush. When the market turns, that gold rush dries up swiftly. If macro goes sour, or if ETH simply begins to trend down, the smallest and least stable firms will be the first to hit liquidity stress. They would be forced to sell ETH, and the price will start slipping. Collateral ratios will then tighten, and mid-sized treasuries that may have also put on some form of leverage will start trimming too. Funding windows will close, stock issuance will slow, and the news flow changes from company adds 50k ETH to company forced to sell ETH. Then even Ethereum whales could begin to feel the pressure. Depending on the broader market environment, firms may be faced with a decision to either defend ETH by buying more into red candles or protect equity by selling into a thin weekend order book. Clearly, the corporate bid that helped levitate both BTC and ETH is pro-cyclical, funded by new equity issuance and debt when times are good. But the sell is reflexive, triggered by risk limits and survival maths when times are bad. With 2.3% of ETH supply already in these vehicles, and a leading forecaster calling for 10%, the impact of a disorderly unwind would be, well, nasty. So when it comes to the price impact, this is one risk that has potential to torch ETH in weeks or even days. A macro drawdown leading to a couple of smaller treasury blowups would be enough to trigger a massive wave of forced selling. And if you're bullish on the corporate ETH standard, you're also implicitly bullish on the stability of their funding. And if that cracks, the supply sink could turn into a supply tsunami, and the whole Ethereum complex could be sent down to Goblin Town. And that leads to our final risk for Ethereum today, and that's technical risk. Ethereum's development has been extremely impressive, but Ethereum's velocity is both a feature and a liability. Back in 2023, the beacon chain stopped finalizing twice, first for about 25 minutes, then again for about an hour, before client teams patched and restarted cleanly. In August 2021, a bug in Ethereum's Geth client caused outdated nodes to split from the main chain. Although funds were ultimately safe in both scenarios, the infrastructure hiccups were very real. The Denkroon upgrade in March 2024 added so-called blobs to /layer 2 data costs, but also birthed a new fee market whose usage and spikes are still being studied. And this is great progress, but it also means more moving parts that add complexity to an already very complex system. Leaving the technical blunders of the past aside, there's also a significant technical risk posed by one of Ethereum's fastest growing sectors: liquid staking and restaking. First, a quick recap. Liquid staking tokens, or LSTs, are tokens users can mint after staking collateral such as ETH. And that lets users utilize the liquidity of staked ETH while still earning staking rewards. Liquid restaking tokens, or RLTs, are the next step, where users can mint RLTs after depositing LSTs as collateral. LSTs and RLTs have both boomed in this bull market, but that's precisely the risk. The total value of RLTs jumped from zero in late 2023 to about $16 billion today. And this repeated use of the same ETH as collateral over and over is where things could get very messy. So far, LSTs and RLTs have displayed robustness, but technical bugs may yet reveal themselves, particularly if we get a prolonged panicked downturn. In a real bear trend, LST and/or RLT depegs and thin liquidity could trigger liquidation loops. Exit and redemption queues and lag in price feeds could even end up amplifying market stress. Pretty quickly, localized shocks spread market-wide. But if all of that sounds unlikely to you, you're technically correct. This is a remote possibility. However, it is a risk that's potentially fatal to the whole ecosystem. After all, let's not forget that the Ethereum of today split from what is now called Ethereum Classic back in 2016 following a DAO exploit. Critical bugs on major chains do occur, and they've occurred on Ethereum before. Now, when it comes to ETH's price in this scenario, we think it's pretty clear. Technical tail risks send prices down at such a pace that exchanges will have trouble keeping up with the rush of selling. Ethereum is robust, but technical failures can upend any system. So that's our outlook on risks for Ethereum. It's worth noting that despite all of this, we're bullish on Ethereum and ETH appears to be in a good position right now. However, it's important to be aware of the risks it faces, particularly when ETH is pumping. So if you learned something from our list today, make sure to hit that like and subscribe button. And if you're wondering what unique risks Bitcoin faces, well, you can watch our video on that right over here. That's all from me today. Thank you guys very much for watching, and I will see you the next time. This is Nick, over and out.